everyone. In this video, we are going to learn about support, resistance levels and charts. Support and resistance levels. Support and resistance levels are an integral part of technical analysis. A support level exists at a price where considerable demand for the stock is expected to prevent a further fall in the price level. The fall in the price may be halted for the time being, or it may be even result in a price reversal. In the support level, demand for the scrip is expected to remain. In the resistance level, the supply of the scrip is greater than the demand and a further rise in the prices is prevented. The selling pressure is greater and the increase in price is halted for the time being. Technical analysis uses support and resistance levels to identify the price points on a chart. It shows the probability of a pause or trend reversal. This chart shows the support and resistance levels. As the name says, support is something that prevents the price from falling further. You can see it in the graph. It is a price point where the traders expect maximum demand for the stock. Whenever the price falls to the support line, it bounces back. The support level is always below the current market price. Talking about resistance level, it is something that stops the price from rising further. It is also shown in the graph. It is a price point where the traders expect maximum supply of the stock. This resistance level is always above the current market price. Support and resistance usually occur whenever the turnover of the large number of shares tends to concentrated at several price levels. When the stock touches a certain level and then drops, this is called resistance, and if the stock goes down to a certain level then rises, there exists a support. The levels constantly switch from one to another, that is from support to resistance or from resistance to support. This support and resistance level gives the trader an idea about the price movements of the stocks, but it cannot be taken as an absolute measure. It is because we cannot say the price will never go beyond support level or resistance level. The price can always go higher or lower than these levels. Therefore, investors should not solely depend upon these support and resistance levels. It gives just an idea about the price levels between which the prices can move. Next is charts. Charts are a valuable and easiest of tools used in technical analysis. The graphical representation of the data helps the investor to find out the trend of prices without any difficulty. Understanding the stock market dealings is very difficult task. People may not be able to study the price points if it is shown in tables. Graphical representation of prices makes this task easier. Therefore, analyzer uses different types of charts to represent the price points. Charts also have the following uses. Helps to spot current trend for buying and selling. Based on the price points represented in the charts, people can see whether the prices are showing a positive trend or a negative trend. It helps them to take buying or selling decisions. Indicate the probable future action of the market by projection. Based on the past performance, analyzer can predict the future. The charts make this task easier. Shows historical movements. Chart shows all the types of price movements, that is whether it is current price or past prices. Indicates the key areas of support and resistance. This chart helps to show this support level below which the prices are not allowed to fall, or the resistance level above which the prices are not allowed to rise. The charts do not lie, but interpretation differs from analyst to analyst according to one's skills, experience, and capacity. A same chart can be differently analyzed by two different analysts. It depends on their skills and experience of the analyst, not on the chart. Chart types. The main chart types used by technical analysts are as follows: line chart, bar chart, and candlestick charts. Let's study about all these charts one by one. Line charts. Line charts are the most basic form of charts. They are composed of a single line from left to right that links the closing prices. Generally, only the closing price is graphed presented by a single point. This is a popular type of chart used in presentations and reports to give a very general view of the historical and current direction. It is clear as well as simple way of getting a general idea of the price movements direction in the market, which is preferred by some traders. This is a line chart. Here we can see a single line which represents the closing prices of the stocks. By looking at this chart, an investor can see the trend. Here we can see an upward trend. This chart does not give much insights into trade intraday price movements. It is because it considers only the closing day prices. But there are investors who consider closing prices to be more important than open or high or low prices. These investors can use this type of charts. It is a simple representation of the closing prices, that is line charts. Next one is bar chart. One of the basic tools of technical analysis is bar chart. Bar charts are also referred as open, high, low, close charts. They are comprised of a series of vertical lines that indicate the price range during that time frame. Bar charts enable traders to discover patterns more easily as they take into account all the prices open, high, low, and close. The opening price is the horizontal dash on the left side of the line and the closing price is located on the right side of the line. If the opening price is lower than the closing price, the line is often colored black or green to represent a rising period. The opposite is true for a falling period, which is represented by red color. This is bar chart. This chart shows all the price points, that is open, high, low, and close points. Here in the left side of the chart, the open, high, close, and low points are shown. The upper and the lower portion of the vertical line is high and low points. The dash in the left side of the vertical line is open price and the dash in the right side of the vertical line is the closing price. Green color represents rising trend and red color represents the falling trend. This is more accurate than the line chart because it considers all the type of price points. Third one is candlestick chart. Another kind of chart used in technical analysis is candlestick chart. So called because the main component of the chart which represent price looks like a candlestick with a thick body and usually a line extending above and below it called upper shadow and lower shadow respectively. The top of the upper shadow represents the high price while the bottom of the lower shadow shows the low price. Patterns are formed both by real body and shadows. Candlestick patterns are more useful over short period of time and mostly have significance at the top of an upward trend and bottom of the downward trend, when the patterns most often indicate a reversal of the trend. The wider part of the candlestick is shown between the opening and closing price. It is usually colored in black or red when security closes on a lower price, and white or green the other way round. The thinner part of the candlestick are commonly referred as upper or lower wicks or as shadows. These shows us the highest and the lowest prices during that time frame compared to the closing as well as opening price. The relationship between the bodies of candlestick is important to candlestick patterns. Candlestick charts make it easy to spot gaps between the bodies. This is a candlestick chart. Here on the left side of the chart you can see two sticks, that is candlesticks. The green and red part of the candlestick is called body of the candlestick, and the line above and below this body of candlestick is called wick or shadow. If the closing price is higher, green candlestick is used. On the other hand, that is if the closing price is lower, red color is used. The shadow above candlestick shows the highest price of the day, and the shadow below the candlestick shows the lowest price of the day. By looking at the color of the candlestick itself, an investor can understand whether it is a bullish trend or bearish trend. Under bullish trend, green is used, under bearish trend, red is used. They can also see the higher and the lower prices of the day easily by using these candlestick charts. Therefore, these candlestick charts gives better idea about the price points than any other kinds of charts. Conclusion: each chart has its own utility. However, their usage depends on the type of trader investors are and strategies that they prefer to put in practice. So, having a general knowledge of the option investors have when it comes to analyzing securities behavior is an advantage. Even though the chart gives clear idea about the market, if the analyzer doesn't know how to interpret the chart, he may make mistakes in decision making. Therefore, everything depends on the skills, capacity, and experience of the analyzer, not on the charts. It is all about support and resistance levels and different types of charts. Thank you.